So we're not in normal markets. This feels weird, and it's as if the markets are taking after somebody in the White House and not caring anymore and just doing what they want.
Yeah, it's been a strange couple of years. Like over the last 3 years almost, we've had high double-digit returns in equity markets. Now, if you take a step back and have a look at what's happened over that period, we've had the Russia-Ukraine war, conflict in the Middle East, trade wars, geopolitical concerns, persistently high inflation, interest rate regimes changing, and the market just doesn't seem to care. The returns have been really quite outsized compared to what you would expect when you had a look sort of what was happening from a geopolitical and economic perspective.
And what is driving the markets not to care? Is it the unlimited growth that seems to be coming out of AI in the Mag 7? Or I don't know, because I think in the first time in a long time, you see all this stuff where, and I think a few weeks ago we shared it on a show where some of the top terms searched in the US was like how to repo or how to sell my car cheap, bankruptcy lawyer, sell stuff, like all this stuff where looking in, a casual observer would think, geez, everything's going to crap.
Yeah.
And it's as if the main street is so much disconnected from Wall Street.
Well, it's really interesting because what you have is a two-speed economy, effectively, and the data at a headline level looks good. So as you say, sort of the GDP is still reasonable, economies have held up. You have a look at somewhere like the US, which is going to, important when you're thinking about the Mag 7, and the consumer is, spending, they're looking fairly solid. However, when you then start to get down into the details of that, what you see is that the vast majority of consumer spending in the US, for example, is actually supported by the most wealthiest consumers. Now, the most wealthiest in the US, there's a wealth effect associated with the stock market returns because in the US, they have one of the highest participation rate in the share markets. So that wealth effect of asset prices has made the consumer confident and they're continuing to spend. When you go down, though, and have a look at sort of the middle and lower class where they don't have as much disposable income, you're starting to see an increase in delinquency rates on credit cards, etc. So there is this two-speed economy and there are some cracks that are starting to show. But overall, as a whole, the headline data still looks okay. Companies, their earnings are actually, they keep beating. We've just gone through earnings season and it has been one of the biggest sort of beat markets that we've seen in a long time.
Yeah, it's so fascinating because when you look at markets and you kind of, hindsight's wonderful and you look at before the GFC and the amount of debt that was around, like the debt isn't there like it was pre-GFC. So it almost feels like, well, are we heading towards a cliff? But then you look at the Mag 7 and I don't know. I just think the whole thing's so weird at the moment. And a lot of people might be thinking, well, why do we talk so much about the US? And, well, the US is important given the size of the economy. And it's just a weird, funky time. And that's not even a question. I'm just throwing fodder out for you to pick at.
Sure. I'll pick away.
Yeah.
Yeah, and you're right. The US is an important area for us to discuss for a lot of different reasons. The size of the economy, the size of the share market and the Mag 7, and we can kind of circle back to that, just how globally important it's actually becoming. But then also the fact that the US dollar denominated finance system that we have. So most transactions that occur around the world happen in US dollars. So it's a really important economy to understand and be across. And a lot of the geopolitical tensions at the moment coming from the tariffs and so forth and how that will then ultimately lead to what's being referred to as deglobalization, so where people start bringing things back in control of their countries. For a really long time, countries have operated during that process of globalization as if sovereign borders didn't matter. So the free flow of capital, of goods, et cetera, between. COVID kind of shifted that a little bit. It wasn't just COVID, though, because there's been, a lot of people would say globalization has been great for everyone, but it actually hasn't. There's an entire middle class where actually, and particularly, and this is why popularism rose quite substantially from a political perspective, there's an entire generation of middle class who are worse off than their parents.
Oh, yeah.
globalization did not benefit them at all. And we're starting to see a reversal of that with his populism. And that's why you're seeing a lot of the policies that Trump's trying to implement.
And it's so savage. Even in Australia, the ABS released, the last tranche of data around the median incomes. It was almost like household income, maybe around 120 as, I don't know, the bottom watermarker, and then daylight, and then 350.
Yeah.
And it's like, okay, where's the middle class?
Hence the two-speed economy.
Yeah.
So it
But
depends on where you're at and how you're feeling at the moment.
The two-speed economy, it's interesting you say that in terms looking into the US. People might be slightly triggered from those words. I know it provoked thought with me when we had the mining boom here in the early 2000s.
Yep.
And to a point, actually, I got so we help people find a financial advisor through our website. We had someone inquire the other day, and they were an admin worker in mining.
Yep.
Both of them, husband and wife, they were both earning $200K each.
Wow.
And so it's still there, but not as savage.
Yep.
I mean, that's a whole debate about, well, if you're sick of FIFOing or whatever, you're not going to find that type of money in your local area. But I don't know, the whole thing's fascinating at the moment. And we are going to talk about this and a whole heap of other random money stuff. But who have we got and what are we doing?
So I'm Jody Fitzgerald. I'm from Australian Retirement Trust, and you're listening to Money, Money, Money.
Before we get into it, this show is general advice only, and I've got a license to provide that advice. Full details can be found in the show notes. I'm a former financial advisor. Now I do the Money, Money, Money podcast. If you're a regular here, we call it M3, and we do a podcast called Retire Right. I've got a book, The Quick Start Guide to Investing, is available wherever good books are sold. There's a link in the show notes if you want to turn up your investing to 11, or if you're just getting started. Let's get into it. Thank you so much for being here today. So if you are listening to this podcast and if it does sound slightly different, or if you are watching us on our YouTube channel, I am actually in Brisbane with Jody today. I came up here to do some podcasts with some various people, and ART, Australian Retirement Trust, they offered us to use your studio. So
yes, it's a
that's
nice
what we're doing.
Too, isn't it?
It's beautiful. Yeah. So this episode, it is actually brought to you by Australian Retirement Trust. Throughout the year, every quarter I like to get someone on to do a bit of an economic update. Brian Parker, Chief Economist, has been to my studio a few times this year, and I'm like, all right, enough with Brian. Let's get Jody. Jody, you've been on, I think you've been on my podcast now for many years.
When you first started doing the podcast, I remember the first podcast I did with you was in the hotel lobby after a conference, and you were still an advisor at that point.
Probably
in time.
had hair.
No, you didn't. I'm sorry to say. Sorry.
Oh, damn it.
Wasn't that long ago.
I missed the bad old days. But yeah, Jody Fitzgerald is the General Manager of Defensive and Liquid Assets, and I'll just have a 5-minute pause, and Portfolio Intelligence. I want to maybe just, before, if you're a new listener here and you haven't heard Jody, I think before I get chatting with people, I like to sometimes get people and give them a sense of who the guest is, so they can kind of understand your shtick and your background. So talk to us about your current role at ART, and then before that, maybe what's your journey been like and what led you into the world of investing?
Yeah. So maybe if we start with the journey and then we'll sort of conclude to sort of where I'm at today. I'd like to say that I had this well-planned career from the get-go and so forth, but that's just not the way life works. Sometimes life is a series of happy accidents. I was always good at maths. I enjoyed economics, so I did economics and finance at university. When I left, I had no idea what I wanted to do, like just being blunt and honest, but I knew I could do maths and I liked solving problems. So my first job, which I often say is my dirty little secret, was as an actuarial analyst.
Oh, because sounds boring.
Hence why it's the dirty little secret. So I decided to go into one of the sort of major consulting firms that had different lines of business because I didn't know what I wanted to do. And at the time, they had put anyone with math capability into the actuarial area and so forth. But it was through that work and working with the investment teams, because this was back in the day of defined benefit superannuation, right? So now I'm showing my age. Was we'd work with the investment team on what were the liabilities that they would need to then work out how to invest to sort of, close out that asset liability matching gap. And I just went, actually, that is so much more fun and a lot more interesting, and that's what I wanted to do. So I sort of then started down the path of working and moving into investment teams, starting out really from a consulting side, so in both retail and institutional, before moving into more of a practitioner role, so running multi-asset portfolios for the vast majority of my career. And I think sort of in terms of how you get there, it's just a series of when you see something you enjoy, try to work out how you do more of it. Someone once said to me, the secret in life is work out what you enjoy doing and then find someone to pay you to do it.
Oh, I love that.
Yeah, and I think that's kind of what I did. I just realised that's more fun than this. How do I do more of that? And just sort of kept moving down that path and finding ways of getting more involved. And that sort of led to where I'm at sort of today, effectively.
Yeah. So I might actually, at the end of the episode, I might ask you a little bit more about, the industry that you're working in and whatnot, particularly such a male-dominated world. So we will absolutely cover that. But let's talk in your current role, and before, we had a bit of a meeting earlier in the week, and we are recording this, everyone, on Friday the 14th of November. So I'm date stamping it now. This podcast is going live on the 27th. So if the world ends over the next 2 weeks,
wasn't our fault.
It's not our fault. We're just stamping it because things can change.
Yep.
Before we hit, we had a bit of a meeting. It's like, what do we want to talk about? And we're actually going to now talk about stuff we didn't talk about earlier in the week because I'm like, I'm curious. So your current role, and I'm asking this because I'm actually interested, defensive and liquid assets and portfolio intelligence. Talk to us first about defensive and liquid assets, what you do day on day for the members of ART. And we've got lots of members of, ART who listen to this podcast. So it'll be interesting for them. And if you're not a member yet, they'll like that, the marketing team. No, if you're not a member, the concepts would be similar in institutional wealth.
100%, yeah. So the defensive part of it, so when you have your superannuation account, it will usually be made up of a whole series of asset classes. Most people know shares very well. Talk about Mag 7, everyone will know what that is. A well-diversified portfolio, they will have a whole series of other asset classes because you want asset classes that will perform differently in different market environments. So defensive assets, what we're talking about there is cash, bonds, credit, be it government bonds, global, international, etc. So everything that would fall into the defensive allocation of a multi-asset portfolio. So it's effectively there to perform differently to your shares.
So some funds, and ART is probably no different, may flag some percentage of infrastructure as defensive.
We call that mid-risk.
Right.
So you have
but that's not your remit?
That's not my remit,
okay.
No. So what we have is at one end you have your growth assets, which is traditionally your equity capabilities. Your mid-risk is where you sit your unlisted assets.
Right.
So they've got a lot more risk profile than your bonds and so forth, but they're more annuity style like you get from a bond. And then obviously you've got your bond and cash capability, which sits under me.
So you're, say, shopping centres and airports and tollways would sit in mid-risk for you guys? Yep, perfect. Yep. Okay, cool. So defensive and liquid assets. So talk to us about, I don't know, if you're managing these assets, what's something that you would have to do in how you manage these assets? Because you probably log into the ART bank account, there's millions of dollars. How do you actually deploy that and make sure it gets deployed?
Yeah, so what the team works on is there's multiple capabilities effectively. So there's that whole, how do we get a good return out of our fixed income portfolio, our bonds, also our cash. Now, as a superannuation fund, we need to ensure that we have cash available. Obviously, that we have, depending on the fund that you're in, a percentage of cash might be a part of the asset allocation. The other reality is that we need to make sure we have liquidity available to take advantage of those opportunities when they come up. or for us to actually ensure that we can meet our obligations. Those obligations could be member payments, or they could be obligations for example, you mentioned infrastructure a while ago. What will often happen with an infrastructure asset is that there are tranches that will fall due. So there'll be capital calls. So we may invest today, but we only give them a portion of the money. And then in a year's time or whatever time frame it happens to be, they'll then ask for another portion of the money to go towards the next phase of that infrastructure asset. We need to make sure that we've got that capital available when it's called upon. But you don't want to just take that money and sit it in cash, because in the interim you want to be earning a decent return from it. So my team's managing that liquidity, making sure that we've got the liquidity available to meet those obligations, allow us to invest in what we want to, but also earning a decent return profile over time.
So if the fund committed to a $600 million thing, call it a asset.
Yep.
And there was 3 payments of 200. You put the 200 in, and then in 12 months you had to come up with another 200 million.
Yep.
How long before that money's due do you have to line up ducks? Like, how easy is it? Is it tough? Because often new super fund inflows, contributions could be used for that, but we've also got equities to buy as well.
Yeah. So there's a whole series of things that we need to look at. So the team will put together a liquidity profile and a liquidity ladder. So we'll have, as a part of our cash, we could have some term deposits, or we could have, cash that is, has different term profiles. So something that we can get tomorrow, something that might take us a week to liquidate, other things that might take 90 days to mature. So we understand when all of that cash is available to us. We also understand when those call options, we then make estimates of the flows that we're expecting from members in both directions. So any pension payments that we might have, or any changes in that flow profile. So if a member switches from our high growth option to our cash option, for example, that's a complete shift in that asset allocation, and that shift needs to be accounted for in the overall investments of the fund. It's easy but not simple, I guess, is the way to sort of say it. You can have the right processes in place to make sure that we're monitoring it appropriately. We have a reasonable understanding of when everything is due. We also then know where and how our most liquid assets are available to us. So if you get into market conditions that become quite volatile and lots of things are changing, we know and understand what are the most liquid assets that we have available to us that we could actually convert to cash to sort of meet any of those obligations.
So I was just looking, ART, I think you're the second largest super fund in Australia with maybe around 300 billion Australian dollars. Does ART or super funds bank with a big 4 bank and sit cash? How does that work under the hood? And obviously you won't be able to tell us stuff that isn't public already, but I'm just curious to see the inner workings of managing billions of dollars at a super fund.
Yeah, sure. So we have lots of different counterparties that we deal with, whether it be the Australian banks, whether it be offshore banks, etc. So one of the things that you want to ensure is you have actually diversification in the counterparties that you're exposed to. So on any given day, we'll be negotiating different pieces of paper with various banks. What rate can we get? Are we happy with that particular rate?
Sorry, everyone, if you are watching, I just looked out the window. Brian Parker's just
he's
walked
loitering
around.
with
He's
intent.
loitering.
Oh, look,
we
now he's
upgraded
waving.
Brian. We upgraded to Jody.
He's jealous. Oh, here he comes.
Mate, I know what I'm not wanted.
Yeah, that's right. We'll see. We'll see you back on the show next year.
No, I thought you'd be summoned to the shed down at South Newcastle.
Yeah, we'll get Jody to the shed next year, maybe.
You go to the shed.
Yeah.
Coffee.
Yeah. He said it's better coffee in my shed. But so we talk about the counterparty risk because, sure, everyone gets 250K guaranteed by the government, but that means nothing when you're talking about billions of dollars. So you're on your own.
Well, yeah. So we need to make sure that we're appropriately, managing the exposures that we've got, that they're across different counterparties, but that we've also got different sort of term structures in place so that so there's different things that you can actually purchase to manage your liquidity, whether it be bank bills or term deposits or various different cash
instruments. So would the super fund buy everyday pedestrian term deposits from like NAB, for example?
Not a pedestrian one, but
You'd obviously get a decent rate
we'll
because
enter
you've got
into
the
term
size.
deposits with banks at rates that suit us.
Yeah, it's fascinating. Always wanted to ask the treasurer, like at Treasury, can they log in and see how much cash is in the government bank account?
Yeah.
And is that a similar thing at ART? Is there one portal that shows you? I don't know. I'm just fascinated because it's so much money to manage.
Yeah, we absolutely do. We have sort of like a look through into exactly where everything's at.
Yeah.
What rate it's earning, when it's maturing, et cetera. And not just from cash, but like every asset effectively.
Yeah.
So we can look through.
How many in the investment team?
In my investment team? So in the art investment team, there's 150 of us, 154, I think, to be precise.
Art does a lot in-house, don't they?
So we actually have a smart partner model. So we think external managers are very important.
Right.
We can't do this alone.
Okay.
It's a lot of money. As you said, it's, we're sort of north of sort of 350 billion. It's a lot of money to sort of manage on our own. We don't claim to have sort of the only people in the room with good ideas, and that's where having really smart external investment managers that we can rely on to partner with.
Right.
Now, we do some things internally because there are some things that just make sense for us to do internally.
Yeah.
So, for example, managing the risk of the portfolio, that's a really difficult thing to outsource.
Yes.
Because we know our portfolio better than somebody else.
And you know your members.
Yes.
Yeah.
So there's elements like our trading capability, the managing of our liquidity, etc.
Yeah.
That's a hard thing to actually outsource, simply because we know our fund better.
Yeah. Oh, it's all just so fascinating. And I will say, everyone, there's actually, I can ask what I want. There's no editorial rules from ART. They've really been great to have on the show. All right. Well, I guess the other part of your job, portfolio intelligence.
Yes.
Are we talking just the defensive portfolio or broader portfolio?
So it's an enablement capability across the entire investment team.
Right.
So what it is our we're building out a centre of excellence for data and quantitative modelling. So as you know, investment markets are more and more data-led. So having quick, easy access to data to inform better decision-making is really important from an investment perspective. So we're upskilling, improving the tools and the capabilities we have there. And when I'm talking about data, I'm not just talking about actual what we refer to as structured data, so a number. There's also unstructured data, which is words.
Yeah.
So the number of company reports or manager presentations that we get, there's all information and data in that. So how do we take that and then help that inform better decision making? So that team is building out data capabilities to take both that structured and unstructured data for us to have better insights over the portfolio and over markets to make better decisions. And the quant modelling around basically how do we, once you have that data information, you need ways of interpreting it because it's a lot of data. So you need ways of modelling it out to understand it. And this is ultimately, stepping towards AI capabilities as well.
And with these, portfolio intelligence and AI, this was happening maybe for years on end, and AI's only walked in the door, 10 minutes ago. Is ART building their own proprietary thing, or how does that work with AI?
Yeah, so we're at the moment exploring AI because it's really important to get the governance right around it, particularly for any organisation, but particularly for an organisation like us where we're stewards of members' money, essentially. So we're still in that whole journey and that whole process of how we're going to actually, what are the use cases for AI? How do we appropriately and ethically use AI, et cetera? So that's still a part of the journey that we need to discover. The reality is, would we ultimately build out our own or buy something else? It's an interesting question because do you want to become a tech company?
Yeah.
Versus do you want to become an adopter and a user of AI? Now,
I just think it's, for me in my life and business at the moment, and I was talking with Jess, who's in our team, we've just got a bit of a mantra. We just use it to do 70% of the heavy lifting.
Yeah.
And because if you don't know your subject matter, you will burn fast because it's going to be wrong.
Yes.
It's not going to, we're a long way from it taking over everything.
Yeah, and I was recently at a conference over at Stanford, on this. And there was a huge discussion around AI and the view that it's going to replace us all, et cetera. And one of the views that I walked away with, which I firmly agree with, is that you won't be replaced by AI, but you'll be replaced by somebody who knows how to use AI. Because it's that intersection of human intelligence and artificial intelligence, which is really important. And what the artificial intelligence does is kind of superpowers up, or like it's a power up, like Mario Brother power up, basically to your human resources that you have in the team and their knowledge and their capabilities.
I mean, in typical Glen style, this conversation's going in every direction, but whatever.
It's a good thing I've worked with you before.
I know. And thanks for your grace, everyone listening. I didn't plan to talk about this, but I will. With the AI stuff, it's great that it does all the heavy lifting, and you need to really know what is black and what is white in your world. Now, if you don't know that, you go downhill. How do you think, and this can be a personal view of Jody, not ART, new grads into your team? Because we need the seasoned people to teach the life skills within a business, because you can't just get a new grad and be like, run along, because there's no almost corporate history or corporate memory or actual practical life skills.
I think this is, and this is just a look glancing forward.
Yeah.
And what are the challenges, not necessarily speaking on behalf of art, but the challenges that the world will face as we step into this. And I think one of the genuine challenges is that, so we mentioned before, the human intelligence interaction is really important, particularly from an investment perspective, because the future is uncertain, it's unknown. So the AI doesn't know what the future is. So you need to make judgment calls over the data and the information that you have. So AI might be able to distill faster for you. You still need to make a judgment call.
But it's weird because all that modelling was happening before AI anyway. So what people are saying is AI is not really AI, but it's probably faster.
It's faster, yeah. It's more efficient, and you can take in more data points and more information, which doesn't necessarily mean it's better, right? Because sometimes more information doesn't mean good information. The challenge, though, which I think will be really interesting, is that most of the adoption, when you look across industries, is really about productivity gains at the moment. So when you actually look into places like the US, for example, the number of investment banks that are reducing their grad program is quite interesting. And the reason why I think it's going to be an interesting challenge for us is that you and I both know when we first started, you learnt your wares by making mistakes, by somebody giving you a spreadsheet to do stuff on, and then someone saying you're wrong, right? And you eventually get to a point where you can look at a piece of information and go, that's not right. And you just instinctively know there's something not right about it. Will the next generation coming through have that learning experience? Now, that's not to say that we can't get past it, but I think it's going to be a really interesting challenge for leaders and managers to how do we train the next generation of people to learn their wares? Because the way we learnt our wares is not going to happen going forward. That's not to say we can't solve it, but it's going to be an interesting management challenge for all industries.
Yeah, we'll deviate back onto the path. So we talked about, at the top of the episode where it's not a normal time, the markets don't seem to care. They're just running along. So what are some key trends that you and your team in portfolio land really looking at? Are we talking bubbles, tulips, all that stuff?
We do get asked a lot about, is there a bubble in tech? And I think it's interesting. What I always do, personally, what I've always done in my career as an investor is sort of take a step back and go, okay, hang on, let's zoom out here and what are the key pieces of information that we should look at to unpack that. So yes, the Magnificent Seven are huge. Actually, and to put it into perspective, the top 5 stocks in the US currently account for 16% of the global equity market. What that compares to is that if you took the top 50 stocks out of Europe, all of the UK market, all of the Australian market, all of the Japan market, and all of Canada, it's equivalent to the top 5 US stocks. So they're huge, right? If you take the top 10, of which 8 are tech companies, it's about 25%. That is exactly the same as the equivalent to the GDP of China or 5 times the GDP of Germany. So this is why you've got this sort of hugely influential and that you've had these multi-year high double-digit returns that sometimes feel like, but it's not reflecting the
Main Street,
tensions.
well,
The Main Street data still looks okay, right? And it's not, but as I said, it is two-speed, so we need to sort of think through that. But it's certainly not reflecting some of the tensions in the world and that would normally impact share markets. But if you then sort of look at them and go, okay, the valuations look rich, and that's the whole question. Is it a bubble? Are they overpriced, or can they be justified? The interesting thing about where we're at this phase of the cycle is that when you actually then have a look at the earnings of these companies, it's quite different to compare it to what happened in the dot-com. In the dot-com, you had really high, rich valuations, but no earnings.
No money, yeah.
There was no money. There was no substance to these. We were basically buying promises, effectively. The current situation is these are highly cash generative, very profitable businesses with extremely high return on equity. So arguably, you could put a case forward saying, well, maybe the higher valuations are justified. Maybe, right? The challenge in all of this, though, is that if you hear some of the numbers that is being spent on AI, like it's something like $1.5 trillion, or it's a huge number. And in a lot of instances, some of this AI hasn't added value yet. So the question for going forward is then that, yes, there's a huge amount of capital expenditure, or CapEx, as we call it, that's actually occurring on AI. The question will be whether that CapEx eventually becomes productive. And that we don't know yet. The reality, though, at the moment, the money that is being pushed into the economy through this capital expenditure is adding to growth. So that's why you've got this interesting situation of the economies haven't slowed down as much, because the reality is CapEx spending at the quantum that it's being spent at is actually good for the economy. Now, what could happen is that expenditure is eventually written off. It's just depreciated because it didn't add value. That's a different question. Then you'll see some corrections come through. So at the moment, it's hard to see what the turning point is. There's some interesting changes, though, in the dynamics of the market that are starting to take place. One is that what you would have seen as a lot of announcements of, be it the modelers of the AI or the people with the infrastructure, et cetera. There's all these cross deals going on.
Yeah, and that's what I wanted to – the scary thing is – when you look at the overlay of, OpenAI, NVIDIA, all these companies taking equity stakes in other companies and this web, it's like...
And when you start to get that web of complexity, that's like the first, you think about the cycle of what happens in a typical cycle, that complexity starts increasing and that's starting to occur. Yeah. It's a little bit hard
Junk bonds,
et
cetera.
Like how do you distinguish between the consumer, the supplier, and the distributor? The web's making that a little bit harder. Some of these deals, so what's starting to also happen is they're starting to finance some of these deals through debt. Whereas before, they're just so cash generative. We've just got heaps of cash. We'll just put it over there and we'll just keep going.
Yeah, so the debt's started to walk in the door.
The debt started to walk in the door. Is it a problem for them now? No, because they've got enough cash to back that debt. But it's an interesting step into the next phase of what is a normal cycle. The other thing that you usually see when you start to hit that sort of bubble territory is you get a lot of entrants into the market trying to take profit share. We haven't really seen that yet. We haven't seen that sort of massive, new businesses and startups and so forth trying to do that profit share. So it's hard to really work out exactly where we are in that cycle, other than to sort of acknowledge that some of these valuations could be justified. It is, as an investor, it sits a little uncomfortably to say they look rich, but they're earning money.
So have you guys seen from your portfolio managers who might manage US equities, have you had any commentary where they're taking some money off the table from some of the Mag 7s?
Quite a few of them are underweight.
Right.
And we have a lot of passive investment in our portfolio as well, which means we get the index weight from that perspective. So on a whole, we would be, slightly underweight these sort of areas. The degree to which you would want to then move substantially away, I just think that's a really hard call to make because the reality is it's really hard to pick a bubble and when it will burst, right? So the degree that there's two calls that you're making when you go heavily underweight an asset. You're making a call that's in a bubble or it's going to have a valuation adjustment. You're also making a call on the timing of that. And what I'm saying in this is the timing's not clear at the moment where we're at in the journey. I think what's really probably more interesting from an investment perspective is trying to understand where do the winners ultimately lie. And it's not necessarily in the companies making the AI. It'll be in other industries that adopt AI that then get better efficiencies, get better sort of balance sheet, control, et cetera. That will probably then be the next phase of that you'll get a better, hopefully a better dispersion of return profiles. Because at the moment, if you break down the return of the S&P 500 and you strip out the Mag 7,
it's flat for the last.
Done nothing really. Yeah.
Far out. So looking ahead to next year, what's your general vibe, or are there any other themes that you think will be particularly important?
I think one of the key themes is that we're going to continue to see volatility. So even though I've mentioned that we've had high double-digit returns, that's not to say it's been a single ride. Like there's volatility all over the place. You'll get an announcement over, and it's usually related to policy, be it tariffs or whatever. Or
if Barron Trump wants to make $100 million, he might tap Dad on the shoulder or steal his phone and make a tweet.
Basically,
all that stuff.
100% right. So there's huge amounts of volatility. So for us, it's being in a position to take advantage of that volatility when it plays out, rather than trying to, for a fund like us that we're quite large, to sort of sit there and try to predict. That's not what we do. That's not the way we invest.
But also you have to deliver what's on the box of the portfolios.
100% we do. 100% we do.
This is a percentage allocation to this sector or whatnot.
Yeah. But what we want to do is that if you actually spend time trying to predict that, okay, let's just say we predicted a certain asset class is going to fall. If you position against that, so in other words, you underweight it, you could actually miss the upside could continue for a few years.
Yeah.
So you actually destroy member wealth doing that. So you miss some of the wealth generation that's available. What we do though is that as these volatility moments present themselves, going back to the liquidity conversation, is stand ready to offer liquidity to the market when the market's trying to sort of move in the opposite direction. So back
to your liquidity and defensive portfolio, if there was an event or something in the equity team, like we think this is a buying opportunity, they may tap your team on the shoulder and say, we need an extra $200 billion. Can you get it to us?
The way that we will usually implement that is through our dynamic asset allocation program. And what they will do is they will usually implement derivatives to those calls. Those derivatives then need to have initial margin posted. So we don't have to post, like to your point, it wouldn't be the 200 million. It would be the initial margin that we have to post to cover the derivative. It would be the collateral management of that delivery. So that's what my team would do to ensure that we can actually facilitate the DAA team taking that position and taking advantage of the volatility.
Yeah, interesting. Well, we'll take a break. When we get back, we're going to talk a little bit about superannuation and some changes that you may need to be aware of. We'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au, and they'll point you in the right direction.
Okay, we're back. What's happening out there in Superland? Actually, I visiting your office here in Brisneyland, went down to level whatever it was and saw Artie, the big blue monster.
He's huge, isn't he?
Yeah.
I don't know how they got him up here.
I know. So for those who aren't aware, what's the story and the shtick behind Artie?
Behind Artie, sorry, not Art. He is our monster.
Right.
And the premise behind him is that most Australians don't realise they're actually sitting on a monster. So when you see the ads, you've got, she's sitting up there on the monster, and this is my superannuation. And what we mean by that is that for most people, it'll be their second largest asset behind their home. For some people, it could be their largest asset if they're not a homeowner. And a lot of people don't realise that, which is interesting because people engage with other assets and they're very mindful of it. But what is your second largest asset? You may not be engaging with it. So the idea behind him is that you may be sitting on this monster. He's a friendly monster. He's there to look after your future and help guide you through retirement. You should sort of bring him out of the cupboard and nurture him and give him a pat. He's looking after you. Make sure you know what he's up to.
Yeah. So log into whatever fund you're with, log in, make sure you're aware of what you're invested in.
Yep.
Beneficiaries up to date. You've got the right beneficiaries. Do a health check.
All those things, yeah, 100%. And if you're uncertain, if you have an advisor, call the advisor. If you don't, call the fund.
Yeah.
Most funds can give limited advice, but if you need more advice, they can point you in the direction of an advisor to assist with that.
So what are the two recent changes that people need to be aware about?
So two of the changes that's occurred over this year, one is the increase in the superannuation guarantee rate, which is great. So moving up from 11.5% to 12%. So this has been
that's the end of the legislative road for that.
Yeah. It's been a part of a multi-decade journey, right, to sort of get superannuation guarantee level to a point where we believe it is the sustainable level that you need to fund retirement. It is the rate that Paul Keating initially suggested, sort of way back when, and it's great that we're finally there because what it means is that everybody, 12% of what you earn is being put aside for your retirement from the day you start earning, compounding over time, the degree to which that can then grow into the retirement savings pool that you actually need.
Yeah, sweet. So that's home.
Yeah.
And the other big one is payday super.
Yes.
Talk to us about payday super for those who might not be aware.
Yeah. So for payday super, so what that actually means is that, rather than having superannuation contributions sort of put in sort of once a quarter by your employer, they're now actually going to be paid on the day that you get paid. So if you get paid weekly, that's when they get in, fortnightly, etc. There's huge benefits to this. And one is one of the first things I ever taught my children was compound interest, the whole idea that your money makes money. So by actually having your money in super earlier, it starts compounding faster, essentially. So that is a huge, huge uplift, having the money in there the day that you get paid. The other huge benefit of it is that there are certain instances of super just not being paid, of it being paid late, etc. So the actual estimates of payday super and what that could actually mean is it could mean members are about 1.5% better off in retirement, which is not insignificant.
Yeah, wow.
Yeah. Plus if you actually then take into account the amount of unpaid super that occurs, which can be in the order of about $5 billion. And that's usually lower paid workers, women workers, migrant workers. So there's massive benefits to this legislation.
Yeah, I reckon it's actually good. We may see some employers want to move from weekly to fortnightly pay or fortnightly to monthly.
Yeah.
But to the business owners out there, just deal with it.
Yep.
I pay my staff and myself weekly, and for the last year or so, we've all paid our super weekly because I said to the bookkeeper, I'm like, this will be legislated. We need to get into the habit now.
Yep.
It's better for me as a business owner because I've got a better true cash flow position.
Exactly.
Less chance of super not paying and, sitting in it's some people are like, we like having super sit here for 3 months and then we pay it to our staff every 3 months. I just think this is such a win-win. And there's no excuse why you can't actually do it with single touch payroll and all that stuff and the clearing houses. So
exactly. And the benefit to the individual is huge.
Yeah. Listo.
Yeah, so the low income superannuation tax offset, which is, also sort of great from that perspective because, there are some people out there that actually pay more in tax on their superannuation than they are actually on their income. So what this tax offset will actually do is basically mean that it could mean up to about $60,000 additional in retirement for some of those low income workers.
Yeah, love it.
Yeah.
In finishing, we've run right out of time, but whatever. At the top, we start to talk about your career and the male-dominated world. What advice would you give to a woman considering a career in finance or investing or economics like yourself?
Yeah, that's a big topic in itself. It's been an interesting journey. I mean, I obviously started my career, I won't quite reveal my age, but a little while ago, and it was probably like, it is a very male-dominated industry. It is changing 100%. When I started, was a lot more dominated by men than what it is now. And some of the practices and attitudes weren't necessarily, welcoming to women. But what I would say is that has changed significantly across the board, not just in businesses, but even in the investment banks and the areas where you would traditionally expect some of that behaviour to continue. I think businesses now really understand the importance of diversity in their workforce. The advice that I'd give, I do think one of the reasons why some women may get turned off investing early in their career, and I had this conversation with somebody recently, is that to be an investor, you need to be comfortable making decisions in uncertainty. And that's not always, like, if you think about, genetically the way women are wired compared to the way men are wired, men with a vibrato and, I know the answer and it's this and just buy that. And what I find with younger women as they're coming through, they feel like, but they know, the guy knows the answer, I don't. So they don't know the answer. No. They're just being more confident about the fact that they think they know the answer. So I think one of the lessons that I've learned is that you need to be comfortable making decisions in uncertainty. However, because of the way women are more naturally risk averse in the way that we're wired, what you tend to find is that women actually make really good investors because we make well-calibrated decisions because we're not going, I know the answer. We're trying to think of. So it's for anybody who actually, genuinely loves problem solving, who's fascinated by markets. It's a great career. It's a really interesting career. It is a lot better environment for women to work in than it was, 20 years ago or more. But there are you've got to silence your own inner critic. As a woman, you're constantly second guessing, but he knows. Why don't I know the answer to that? Well, actually, he doesn't. So it's an interesting journey, I think, for women, and I think it's a fantastic career. I mean, I love it. As I said before, work out what you love doing and find someone to pay you to do it. Women, there's a confidence element in silencing that inner critic. And knowing that you're making decisions uncertainty and you're not going to get them all right, and being comfortable with that. If you get 6 out of 10 decisions right as an investor, you're making money. You're actually probably making a lot of money if you get 6 out of 10 decisions right. But being comfortable with it, you will get some of them wrong.
Final question. Heading towards the end of the year, it's a natural time for people to start thinking about their goals for next year, new me, all that stuff. New year, new me. What are some super and investment related resolutions that we should be thinking about?
Well, so going back to what we talked about earlier, look at your super. Just have a look at your balance. Have a look at your statement as it comes through. You've probably got listeners that haven't even looked at it this year or maybe even for a couple of years. I think it's really important it doesn't matter, the earlier you start, the better off you're going to be in retirement. If you start looking at this when you're in your 50s, it might be a bit too late to make changes. So I think everyone should just have a goal of engaging with their super a lot more. Now, I'd also like to point out engaging with your super doesn't mean constantly trying to switch things around. Because that can actually degrade the value of your, and for example, if someone tries to predict what's going to happen in the world and going to move from high growth to cash, most of the time you're probably going to do that at exactly the wrong moment. So, but be engaged with it, seek advice if you need the advice, make sure you understand what is arguably your largest, if not your second largest asset that you have.
Anything that maybe you wanted to get off your chest that I didn't ask you? Sorry, I went in a lot of directions and I must apologise and thank you everyone for their grace. Sometimes when I'm in a different studio set, I don't feel like I'm 100%. I don't know. It's just weird. So
knocked off center a little bit.
A little bit, yeah.
Yeah, that's fine.
But anything that?
No, not really. I mean, there's lots of interesting stuff happening at the moment we could talk about, be it tariffs, be it, because there's a Supreme Court.
Actually, so on the tariffs, interesting. I got an email because I use Squarespace. Like, I reckon they're kind of there to stay for the medium term, particularly in the States. Well, that's the only country that's dicking around with all this stuff. and they're talking about, okay, here's ways you can implement to cover the tariffs when you sell online. And it just flies in the face of the propaganda from the administration where we punish other countries. It's like, no, your own citizens will end up paying for them.
At the end of the day, tariff is a tax.
Yes.
It's a tax. It's a tax on the citizens who, to your point, which has kind of been interesting because all of the experts, when the tariffs come, like, this is inflationary. It is, but it depends. The definition of inflation is persistent rise in prices. The tariffs have been a one-off rise in price, and it's been a one-off rise in price that is effective to a tax. So unless you then get more money circulating around the system or give people more money in some other ways that they then start spending more, that one-off hit has occurred, impacts the cost of living. The degree to which there's a persistent inflationary pressure is not necessarily going to occur because, as you say, it's a tax. What's going to be interesting, though, is at the moment it's playing out in the Supreme Court whether or not it's actually legitimate that he could have used the legislation that he did, which was to sort of push them through. The reality is, from my perspective, because there's a couple of ways he could have implemented tariffs, and one of the legislations that he actually used was the International Emergency Economic Power Act, which basically means that the president can use, can put certain things in place to control international commerce if they've declared a national emergency. So they usually use it for things like sanctions or freezing assets of terrorists and stuff like that. So they're arguing you couldn't have used this for tariffs. Cold hard reality is only about half of the tariffs have been implemented through that. There are other legislative means that he can use. So the market's gone, yay, tariffs will go away because the Supreme Court will overturn it. And you saw all these consumer discretionary stocks rally. What you have to believe for tariffs to go away is that, one, he won't find another avenue, and there's other sections of the Act that he can use, so he will, or that he won't just pass a new law. You also have to believe that the trade deals that have been put in place with the other countries will be thrown out the window. That there were a lot of negotiations that took place. It's hard to see them going away. So I think tariffs are here. They might shift and change. What this whole Supreme Court case thing does, though, is increase the uncertainty. It takes longer for us to digest what this really looks like at the end. But going back to the inflation, is what we haven't seen is the other side of that. So Trump announced a couple of weeks or last week this $2,000 tax rebate to all citizens, which was he was calling it the tariff dividend. So and this will then become interesting for inflation because, as I said, it's a tax. But if he's then turning around and pushing the tax payment back, you're effectively pushing more money into the economy. And we've got some of the spending coming up in the One Big Beautiful Bill next year, some of which is defence spending. So you're going to see this economic fiscal push into the economy, which will be interesting. So you've got a tax on one side, which has actually made it harder for the consumer and the economy, but all this fiscal spending's coming, which will make for an interesting and another volatile year next year.
But with, old mate, every time he tweets something and there's a reaction, it's the boy who cried wolf, because I think markets now, in the main, no one cares what he says because half the time he's talking BS anyway, and it doesn't come to light.
Yeah, well, and that's the thing because the market just doesn't know when to digest the news.
Yeah.
But then on the flip side, as I said, the Supreme Court case, all of a sudden all the consumer stocks rally. I'm like, well, but do you really believe that tariffs are going to go away? It's just going to take longer for the whole thing to be digested, essentially. Yeah. So, and to the point, markets have done really well, but the volatility, it'll stay.
And to be fair, it is probably going back to the Mag 7 holding everything up anyway.
Yeah.
So, because, ordinarily markets are forward-looking and you cut the 7 out and the market's done nothing, so there's not much excitement for most of the other companies because, remember, there's another 493 companies in the S&P 500.
Yep, there's quite a few in there that's still,
Look, we'll leave it there. Jody Fitzgerald, thank you so much for joining us on the podcast today, and we'll have you back on next year, no doubt.
Thanks for having me.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services licence 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective licence holders.